Hey guys, welcome to the first video in this series where we're going to be talking about swing trading. So today I'm going to be talking about RSI and what it is and how you can use it in your trading. So getting to what it is, it stands for Relative Strength Index, and it measures the recent performance of a given stock by comparing it to its past performance. Many investors / traders usually use the RSI to figure out whether a stock is oversold or overbought. The way it's calculated is you get the average gain of a stock on its green days within a period, and then you get the average loss on red days in that period, and then you plug it into this equation where you actually end up with a number. And that number is from 0 to 100, and what most people use is like if the number is below 30, then a stock's considered oversold, and if the number is over 70, then the stock's considered overbought. So now let's get to a real example and see how it can be applicable. So here I have the stock of Starbucks, and as you can see, like every stock sort of goes up in a pattern or goes down in a pattern. So as you can see here, it like sort of goes up, then it comes down, then it goes up, then it comes down. And stocks usually move in these oscillations. So essentially what the RSI can do is sort of tell you where in its oscillation a stock is, like whether it's towards the bottom or towards the top, and whether you should buy or sell. So I'm using Yahoo Finance here, and in order to get the like to set up the indicator, you just go here over to the indicator section. You can click on it, and it's one of the most commonly used indicators, so you can just select RSI here. We're going to be using a 14-day period since that's the most common period that many investors use, and we're going to set overbought to 70 and the oversold range to 30. Once we click save, you'll see that an RSI indicator would appear on the bottom here, and it sort of shows you what the RSI is during a particular moment in the stock's price history. So if you see here, when Starbucks actually fell a lot, RSI was actually in the oversold area, and then when it surged, it came into the overbought. So what a lot of people do is they buy a stock when it's oversold, when it's below 30, and then they end up selling it when it's in the overbought range. And usually this can be a very effective swing trading strategy. And there's a lot of stocks on the market that actually follow like predictable patterns. So they'd actually oscillate a lot between oversold and overbought. And if you can calculate the average percentage gain between the oversold and overbought areas, you can sort of have you can set goals basically. So if suppose you want to make $50 a day, you can sort of see how long it takes from it to go from oversold to overbought and what's the average. And from that you can sort of set goals, and you know how much money you need to in order to meet your goals. So this can be a very good swing trading strategy, and it's really useful for beginners. So if you're just starting out in the market, this can be something you can experiment with, and it's very low risk if you put in less money and you control your risk. I wanted to add that RSI is not only useful for trading, but it's also useful for things like investing. So suppose you have a company that you want to enter and you feel that this company is going to do great in the future. So you can actually time a very good entrance by using RSI. So if you buy when the company is oversold, you can get a relatively cheap price, and in the future you can have better gains on this company. So the RSI is actually a very useful thing for almost any trader or investor on the market. So thanks for watching, guys, and if you feel that you've learned something, please do subscribe and smash that like button. See you next time.